Good afternoon. This is Craig Model Mog. This is April 1st, April Fool's Day, 2020. This is my new gig. This is going to be my new presentation type of platform here, which is really designed to be a lot more informative. Not that it wasn't before, but a lot of the information and the data that I was spewing out to you on a regular basis, now I've got slides to support it. So it's going to get a lot more exciting. So welcome. Please give me your feedback. Shoot me emails on this. Say, hey, Krager, this is fantastic. I love it. You can say, hey, Krager, you know what? Nice try, but that was terrible. Go back to your old deal. You know what? I'm always open to feedback, and whether it's good or bad, it just helps me get better. But I hope you'll enjoy this today. I think it's going to be a lot of fun. Moving on here, we'll start with the disclosure, which you can see here. Obviously, the information on this is mainly for educational and informational purposes only. None of the information contained herein contains an offer to sell and or solicitate an offer to buy any security or investment vehicle, nor does it constitute an investment recommendation, legal, tax, accounting, or investment advice. I'm not going to read the rest because you might tune out, okay? Because this is the total disclosure, but it's okay. It's all good here, okay? So top three things. What is the cost of being too early? Oh, I know. I mean, I'm piquing your interest here. Next, we're going to give an update on the Fed. And then finally, we're going to give an update on inflation. Okay, let's talk about the costs of being too early. Goldman Sachs did an interesting study. And obviously, with all the market volatility, people are always trying to think, man, is there opportunities out there that can help me understand the opportunities as they present themselves? Is it good to get in too early? What if I get in too early? What if I get in too late? This one really focuses on timing the markets. And if you get in, 15% too early, see, I can draw. I'm so fired up here. I have to draw a heart because this is literally how I'm feeling. You can see my heart is just really pathetic. But you know what? It's exciting, and it gives me another tool or another toy to play with. Then it talks about being early by 10% and 5%. What they found out is that, while the base case historical data suggests that being 5% early to a bear market, okay, only saves you 2 days in recovery time versus 15%, gives you an average 49 recovery days. I always like to say this. It's not trying to time the market and getting out of the market, okay? Because that's the easy decision, and that is a hard one. The harder decision is when to get back in. Meaning, if you got out of the market here, as the markets are tanking, are you going to have that warm fuzzy feeling? Say, oh wow, I think I need to buy here. You're not, okay? Emotions won't allow you to do that. And what often happens is you see the market fully recover by the time people get in and start investing again. So the kicker is this: you really want to have a full market investment cycle, which is really what I try to execute for all of my clients. It's defined, it's repeatable, it's unemotional. You've heard me talk about that a long time, but it gives us as investors the best opportunity to invest through the entire market cycle versus just investing during pieces of it, meaning my investment is good for now, but if the markets change, then it's not so good, and I just have to wait till it gets better, okay? That's not how we like to do it. Moving on, update on the Fed. This is that chart I've been talking about when it comes to the Fed funds rate. First of all, the Fed funds rate, just as a quick reminder, it's an overnight short-term lending rate that banks use to lend to each other. So they take all their cash that they're sitting on, they lend it out overnight, they get it back in the morning for business, okay? What the futures market does, it's a predictive tool that based on current information or current market activity, it tries to project out a value, a price target. In this case, the number of Fed rate hikes, which is at 8.43%. I don't think that's going to happen because I don't think the market can handle a yield curve that's inverted. And we're going to look at the yield curve here in a couple slides, okay? This next slide shows you how the Fed funds has a target rate as of today of 2.51%. My chart goes 2.49. That's because it's a day younger than my number today. This also shows the 2s, 10s spread. That's this black line that I'm scribbling on here. What is the 2s-10 spread? It means it's the difference between a 10-year treasury and a 2-year treasury, which has gone down to be super, super small. That does not bode well for the markets, because it shows that inversion is imminent. That's the word I'm looking for on this Friday afternoon. Okay, I don't think that's going to happen. If you look at the next slide here with the yield curve, this gives you, the date was yesterday, and this is what the value of all these bonds. So you have a 1 month treasury, 2, 3, 6 month, 1 year, 2 year, clear out to 30 year. You can see the yields here. So you've got a 1 year treasury at 1.63. You've got a 30 year at 2.44. You've got a 3 year at 2.45. Here's the question. Why would you buy a 30-year treasury when you could earn the same thing for buying a 3-year treasury? Okay? You wouldn't. You're not going to lend your money for 30 years and get paid the same value for lending it for 3. Now, let's think. If the Federal Reserve raises the Fed fund rates to 2.5, which was its target, what does that mean? That means you've got short-term rates higher than long-term rates. That is called an inverted yield curve. That is very bad. Most of the time when that happens, that means that we are in a recession. Okay, so for the Fed to sit here and all these big institutions to sit here and tell you that they are going to raise rates that many times, that is crazy. Okay, moving on. Next slide. Inflation update. First, let's talk about deflation versus disinflation. Big difference. Deflation, as you can see here, the action or process of deflating or something being deflated. From an economic standpoint, this is the big one. Okay. A reduction in the general level of prices in the economy over time, negative year-over-year price changes, okay, versus disinflation is a period or process of slowing. Sorry, I'm terrible at writing with my mouse, but that's okay. You get the gist of it. Big difference. This is a declining value over time. This is a slowing in the rate over time. What does that mean? If you get to disinflation, this is a great slide. There have been 4 periods of deflation since 1948. Here's 1, here's 2, here's 3, here's 4. You can see the time frames. This is the Depression. Okay, this is World War II. This here is the 70s. For those of you old enough to remember the 70s, interest rates were off the charts. They were double digits. Okay, this is the financial crisis. Kind of crazy. Now, disinflation has happened in 14 periods over that time. Happens much more often. Right now, we are disinflationary. This is not a deflationary period. Could it turn into that? It could. For now, it's not. Okay, so what does that mean? Watch and wait, and I will let you know. Moving on. Let's talk about inflation. Inflation is likely to decline, but it's not going to go away. This is Q1 in the first quarter of 2022. You're going to see inflation peak out at close to 8%. What happens is the data is starting to show what? A deceleration in inflation. Okay? But still elevated. If you go back here, you're going back to 2019, 2020. What do we see? 2%. What are we talking here? We're talking, anywhere between 5 and 5.5% by the end of this year. We're a long ways from 2%, people. Okay, so this inflation gig is going to stick around for a while. How long? I don't know, because I don't know how aggressive the Fed is going to be able to be at combating it, because I don't think they have the guts to push us into a recession, particularly in an election year. Okay, moving on. Deceleration's already in motion. This is the IMSM services. What that means, it stands for the Institute of Supply Management. This measures the overall economic condition for non-manufacturing. You can go back here and see, going back to 1998, how this kind of hovers up and around 55 to 60. You can see these points. What are these gray areas? These are recessions. This was the pandemic, very short-lived, right? Didn't last that long. Obviously, we have a crash to the bottom. We have a spike to the all-time high. That's a long time. That's as long as they've been keeping this thing. You can see where we're going today. This is not good. This 50 mark here, if we go below 50, that's bad. That's all I'm going to say. Okay. ISM manufacturing, you got it. Manufacturing companies, the 50 line again. Recession, recession, recession. Here's where we're going. Okay. That's going to be a good one to watch. Business confidence, slowing. Recession, look at this. We're there. This is financial crisis. This is pandemic. Where are we going? Again, going to be interesting to watch. Moving on. Housing is slowing. You say, what do you mean housing is slowing? Well, I'm saying housing since October of 21 pending home sales has continuously month after month declined. That is not good. This is a great chart. The chart on the left says that we've seen the largest increase quarter over quarter in mortgage rates in quite some time. Mortgage rates right now are at 4.89%. This second part of the chart over here on the right shows us that a couple months ago, mortgage rates were at 3.1. This shows you an average monthly payment of $1,575. That would have bought you a home of $369,000. Let's go back to when rates were at 3%. You can see that would have bought you a home at $373,000. Now, fast forward to today, 30-year mortgage rates are at 4.89%. That would, in order to have the same mortgage cost or your payment monthly at $1,575, now you're only buying a home worth $297. This is a 20% decrease in the amount of home you can buy in just a very short period of time. Housing is starting to roll over. Also look at consumer confidence, bad. Looking at the University of expected change in financial situation, extremely bad. Recession, recession, recession. Where are we at? We're way down there. Kind of interesting, isn't it? Kind of interesting. Now we're moving on. I'm not going to sing to you. I'm not going to play that stupid song like I did last week. Tanya's like, Krager, seriously, you played a song. Tanner, I'm sorry. I'm cleaning it up. Cleaning it up today. Okay? This gets good. This talks about the inversions in yield curve. You're hearing lots of people on the financial network, CNBC, that's like comedy network. And I'm not being facetious on that. I'm not over exaggerating. It's comedy. It is comedy. They're saying an inverted yield curve means nothing. Okay? This gets back to, again, this talks about the 2s, 10s yield curve. That is the dark black. Okay? The blue is the S&P. Here's what's interesting. What do you see when the 2s and 10s starts to decline? What's this? This is the S&P crashing. Okay? You see it again here in the middle we're looking at October 15, October 16, 2s, 10s was coming down. Here's what's interesting. What started happening in 2008? Really in 2009. You know what that spells? TARP. That's called quantitative easing. That is called the federal government loading up their gun and trying to prevent catastrophe. This is when it started, TARP. Look at what the S&P has done. You see a few blips in here, okay? You get a few blips, all right? Here's what's fascinating. Look at what has happened from here. You see a peak in 10s, 2s, it is tanking. What's happening to the S&P? Yeah, think about that one. Going to get interesting. Moving on here. This gets into oil. Biden recently did the greatest release in oil reserves on record. This is interesting. Blue line is U.S. oil reserves. That's what he's just tapping. okay? Black line is cost of oil. The shaded area is the 5-year range from peak to trough. Tell me this, if Biden is going to cut this downward in reserves, in which prior to him cutting or tapping into reserves, inventories were already 14% below their 5-year average. If he's cutting into reserves, and the only way to fulfill or build back up reserves is to what? Start pumping more oil. When Biden got into office, he shut down all pumping or new oil drilling on federal land, and he made it harder for current companies that are drilling to get new wells. You just don't flip a switch and start pumping a ton of oil. It doesn't happen that way. Last one here. S&P 500. This is interesting. Slide here or on the left here that I'm marking on. This represents the top 10 companies in the S&P 500. That happens to be Apple, Microsoft, Amazon, Google, Tesla, Facebook, Nvidia, Berkshire, UNH. I'm not sure what that is, and I probably missed one. Anyway, it's that group of companies. All right. They make up almost 30% of the S&P as far as their size and the amount of people that own them. They also make up a quarter of the earnings. Here's what is fascinating. You have 10 companies out of 500 that make up 30% in the weighting and 25% in the earnings. Do you think that is a good thing? It's really not. It's really, really not. Talk about things that make me go, Anyway, that's it. You guys have been great. I hope today was good for you. I hope it really drew you in and provide a lot of great detail, because my whole focal point is to educate you all. I want you to understand what's going on so you're not afraid of the news. I want you to understand what's happening. That is my goal and is going to happen. Keep tuning into these. These are going to keep getting better. I'm going to keep getting better at my little fun tool, and I'm really hopeful that it's going to be even more educational and more informative as we go forward. So, Craig Modelmog, Wall Street X's and O's for Friday, April Fool's Day. By the way, this is Cornerstone Wealth Management's 13-year anniversary. All I can tell you guys is this. Without you, Tanner and I have nothing. I cannot thank you enough for your support. I can't thank you enough for your loyalty. We are humbled that you give us an opportunity to serve you guys. I want you to know that, because without you all, Cornerstone Wealth Management would not exist. It wouldn't have made it this far. So thank you so much. We love you guys. And until next time, I am out.